So financial accounting. That will be a very quick overview of the financial reporting. Why do we need financial reporting? Who needs the financial reporting? And for what purpose we can use it? So let's see, what's the financial accounting? Well, financial accounting is the process when we recording, analyzing, and reporting certain events, which are called transactions, and information about those events on the financial statements, which are presented to the users. Which are the users? The users are only investors, creditors, and management. Under the investors, you can have a different type of investors. Under creditors, you can have different type of creditors. Under management, you can have a different type of management, but the main users are investors, creditors, and management in those categories. How often are we going to prepare those reports? How often we're going to capture the picture of the company, analyzing, and we're going to report those annually. We're going to do this during the year. So once we know the users, let's see which are the stakeholders. We can have a different type of stakeholders. We can have the employee union, you have the management, you have the auditors, you have the potential investors and customers, some analysts, brokers, advisors, regulators, board of directors, and the next broad section is the creditors, suppliers, and landlords. Which are the questions that they may ask about the business? Is the business profitable? How the sales are compared to the last year? How the company presented financial information? Is the company presenting financial information fairly? Is there any mistakes? What was the long-term perspective of the company? What are the company trends? How the company comply with the financial reporting standards and the requirements? Has the company generated sufficient return on the investment? Should we extend the credits for this company? Those are all different type of questions, and each of those users or stakeholders is going to ask himself. And as you can see, manager is going to ask one questions, creators are going to ask different questions, stock analysts are going to ask questions related to what they're doing, regulator is going to ask questions which are related to their level of expertise. So, financial statements users, we can easily split them on the internal, inside the company, and external, outside of the company. And the external users are far more than internal users. In internal users, we have the management. With external users, we have the shareholders, board of directors, investors, creditors, regulators, tax authorities, other corporations, which are competitors, credit rating agency, unions, just journalists. So for the shareholders and the potential investors, we're going to include the shareholders, the board of director, and the potential investors. Shareholders have the one who investing the resources in the company, and they want exchange for shares for the ownership. Corporation, which is the company, can be different types. It can be private company with the single shareholders, or it can be public companies with number of shareholders. Which shareholders in that case? electing the board of directors. Additional users that will be creditors, which are financial institutions, suppliers, regulators, tax authority, and other users. Now that brings us to the question, what is corporation? Corporation is a separate legal entity, if we can say it that way, separate legal entity, which is owned by shareholders who provided cash or some other assets in exchange of the shares or in share certificates, which share certificates are called common share. Again, the corporation is separate legal entity, has nothing to do with the owner. Owner is not associated with the corporation. The owner owns common shares, which belong to the corporation. We have two main types of corporations. One is public, the other one is private. What means public? Public corporation or public company. Those company, everyone can buy their shares because they're available of the secondary market, which is called stock exchange, which is available to public. Private company, those shares are not traded on the open market, public market. Those are traded privately. So which the key distinction between the form of the business? Well, we have a different three main form of business. We have a proprietorship, we have a partnership, and we have a corporation. Proprietorship is when the owner is the individual. In that case, there's no legal separation between the business and the owner. For that reason, the owner as an individual is responsible for the entire debt of the company. Proprietorship is not taxed by itself, where the profit is transferred to the owner and owner is taxed as an individual. Cost to set up the proprietorship will be pretty much nothing. You can start your business right tomorrow. To maintain it, very inexpensive. Does he have to make the financial information available? No. Second on the level of difficulties to set up is the partnership. Compared to the proprietorship, where it has one owner, the partnership has to have two or more owners. Once you set up the partnership, is that going to be a separate legal entity? No, they're not. Some of the partners has to bear the risk. There are special purposes on partnership on which you can avoid some of the liability. But for the partnership, general rule is the owners is responsible for the debt of the businesses on the personal level. Again, the partnership is not taxed as an entity. The taxes are applied into the hands of the individuals. The cost to set up partnership is not that high. It's a little bit more expensive the proprietorship, but definitely less expensive the corporation. And the cost to maintain it is pretty much will be the same as a corporation because you still have to hire the accountant. Do you have to make the financial information available? No. And the last one, the most difficult, is the corporation. Why? Because different setup. Again, the corporation is the separate legal entity. Can one person open corporation? Yes. Can two people open corporation? Yes. So for the number of the owners, it doesn't matter, as long as it's set up as a separate legal entity. Then we transferring the risk into the company. The owners are not liable for the debt of the corporation, only to the extent of their investment. The corporation is taxed separately. Cost is the most expensive. To maintain it, yes, it's more expensive. Do you have to make the financial statements available for the public? Yes, you have to. And that will be on the monthly basis. It can be the quarterly basis, can be annual basis is the most. Which are the business activity? Again, in the business, we're going to have three main activities. One is the operating activities. The other one will be the financing activities. And then we'll have these investing activities. Let's see financing activities. What is the financing? From where the company gets the resources and how the company spend the resources. Company has two options to get the resources. First, from the investors, which invest their money and get common shares, and creditors, which again lend the money, and after that the company has to pay them back. So the typical financing activity involve, again, cash coming in and cash coming out. Every time when we borrow the money from the creditors, we're getting cash. Every time when we issue shares to the investors for the investment that they make, give to the money that they give us in the company, that's another cash inflow. What will be the cash outflow? For the creditors, for the money that we borrow, now we have to pay them back. So any repayment of the loan principal, that will be the cash outflow in relation to the creditors. Now, the investors, as you remember, when they give us some money, we give them common shares. What they can get? Well, they can get a dividend. Every time when we pay dividend on the shares that we give to the investors, that will be the cash outflow. Which are the investing activities? Investing activity including buying and selling a property, plant, and equipment, and buying and selling shares of other company. So every time when the company has excess cash, they want to do something with it. Which are the available options? Once you have the excess cash, you can spend the money. That will be cash outflow. And the cash inflow will be from what you're selling. So let's see the inflow. The inflow that can come from investing activities when we sell the equipment or property, plant, and anything that we have as a long-term asset. Once we sell it, we're going to have cash in. Or every time when we sell the investment that we made in another company, we're going to get the cash. For what we can spend our cash is to purchase a new property, plant, and equipment. We can purchase new machinery, we can purchase new equipment, we can purchase new furniture, so we can purchase anything which is related to our business. But that will be investing, because you're investing on the long-term sustaining of the company. The other thing that you can do is to purchase shares as an investment for another company, expecting that the shares price is going to go up and you're going to cash on that one when you sell them. Operating activities is the one that the company is originally set up. What's the main operation of the company? So basically, when you open your company, you're not relying on the financing and then the investing activities. You're relying on the operating activities. So which are the flows of cash here? That will be revenue expenses. Cash, from where the cash gonna come from the operating activity? That clearly comes from the customers. We're gonna sell our product, whatever the main purpose of the company is, and the customer is gonna give us money. That's gonna generate cash inflow. What's the cash outflow? That will be the payment that we have to make for the business expenses, for our normal operation. How many financial reports we're gonna have to prepare at quarter, at year end, or every 6 months? First, we have to prepare statement of income. Then we have to prepare statement of the changes of the equity. Then we have to prepare statement of financial position or balance sheet, statement of the cash flow, and we have to prepare notes to financial statements. What we're gonna find on the statement of income? We're gonna find from where the money coming in the company, or from where the income comes from. So what we're gonna have? We're gonna have a revenue or sales, and then we're gonna have expenses. The difference is gonna give us net income. Which are the common items that we can see on this statement? That will be the sales revenue. What else we can see? We can see other income. From where other income is gonna come? Either from the interest that we are earning, either from the sale of the property, plant, and equipment that we're selling. What else we gonna see? We're gonna see expenses. One expense is the cost of goods sold. Every goods that we're buying come with the cost. If once we're selling them, that's become cost of goods sold. Then we're gonna see some other expenses which are related to our operation, as a selling, general, and administrative expenses. And we can see some other expenses as well, like a depreciation, like a interest, income tax expenses. After that, we have to finish the statement of income after earnings per share disclosure. So we have to tell our shareholders, for every shares that you own, how much did you earn? Statement of the changes of equity, that will give the idea for the shareholders how the equity has changed during the period. Here we're going to have two main components: the share capital, the initial investment from the shareholders, plus any subsequent investment that they might have made. And the next one is the retained earnings. We're going to talk about the retained earnings a little bit later. Now we're just going to mention it and going to leave it there. Statement of financial positions. Statement of financial position is going to present a picture of the company at the current state, at point of time, or what company has at this point. That's also called balance sheet. So the balance sheet is going to have three sections: assets, and the assets always and always will be equal to liability plus shareholders' equity. And that brings us to the accounting equation, which is asset equal to liability in shareholders' equity. The other way that you can see it, this equation is asset is equal to liability plus equity. That's another way you can see this equation, only with the abbreviation of the letters of the words. Keep in mind that this always has to be in balance. Whatever you have on the left side has to be equal to the right side. So that means that the money that you have in the company and the assets that you have in the company, they either come from the liability or from the creditors, or either come from the shareholders. Liquidity. What's liquidity? Liquidity is something very interesting, which is related to the ability of the company to transfer the assets into cash when it's needed. So assets and liability, those will be classified on the financial statement of financial positions, but they will be current and non-current. So liquidity, again, it will be how quickly something can be transferred into cash if we have to settle something, or we have to pay something, or we have to invest it. The common measure for the liquidity will be the working capital, which is only and only current assets and current liability. We don't care about the non-current category, because the non-current categories are the one that is hard to sell right away. Now on the balance sheets, again, we're going to have these assets. What's the definition of the asset? Asset is an economic resource which is held and controlled by the corporation, in general by entity, from which we expect to generate future economic benefits, either to sell it, either to use it, and also give the company control of the economic resources that already have. Example will be cash, investments, accounts receivables, inventory, prepaid expenses, property, plant, and equipment, which now we're going to the category which is the long term, rights of use assets, intangible assets, goodwill. Those are just examples. Now we saw what the asset is. Let's see what the liability is. Liability is present obligation of the entity, which is expected to be settled in the future with the economic resources, either cash, either some other means, for something that company did in the past. So the definition of liability has the all 3 points of time. We have past, present, future. Again, at present time, we have obligation to pay something in the future for something that we did in the past. So the actual event has happened in the past. The payment's going to happen in the future. The question today, did we pay for this? No. If we haven't paid yet, that means that's a liability. Do we have obligation to pay for something that we did in the past, in the future? Yes. Then we have a liability. Examples will be bank indebtedness or bank loans, accounts payable, deferred revenue, notes payable, dividend payable, any accrued liability, tax payable. And then we go into the long term, which are long-term debt, lease liability, and deferred income taxes. And we're coming now to the last point, which is so now our equation, assets, liability, equity section. What's the equity? Equity is the interest of the shareholders in the assets of the company. That's usually is reflected as net assets. Why? Because as you can see from the accounting equation here, if we have to do the again account asset equal to liability plus equity. Now the question is, how can we express the equity? Well, equity from this equation, equity will be equal to assets minus the liability. When we, from the total assets, we deducting the liability, that's going to give us directly the net assets of the company. And again, this is the amount of the assets that will stay in the company after the company settle all the liabilities. Two accounts we have in the equity section, that will be the share capital and retained earnings. Again, Net assets represents assets minus the liabilities. Share capital. Was the share capital? Remember, one of the sections of the equity was the share capital here. Share capital. Let's see what the share capital is. Share capital represents the shares that have been issued and held by the shareholders. That amount is equal to what was originally paid by the investors for the shares. Well, there will be a market value of the shares, but that market value is not going to affect our company. At the end of the day, we're going to record only the money that somebody paid for our shares, and that's all. Retained earnings. What's the retained earnings? Retained earning is the everything that left in the company as an income. Okay, so let's see. This is the first year of the company operates. Company has income of $100,000. Company decide to keep those $100,000 net income in the company. That become retained earnings. If the owners decide to take some of those $100 that the company earned, they can take it only as a dividend. So let's say the first year of operation, company generate net income of $100. The owner decide to take half of it as a dividend. So they declare and pay themselves $50 dividend. So the retained earnings from the income that left from the first year in the company will be $50. Second year, the company generate $200 income. But because only $50 left from the first year, from the $100 income minus the $50 dividend that they paid, now the retained earnings that stays in the company $250. And the same pattern, the next year the owners of the company may decide to declare dividend. The dividend is going to reduce the retained earnings. Every time when we have a net income, that's going to increase the retained earnings, and then going back and forth, back and forth. The whole point is you to still have retained earnings. The owner of the company can take a dividend only and only when there's a retained earnings. If there's no retained earnings, no dividend. Statement of the cash flow is the fourth statement that we have to prepare, and that's including information about the cash during the specific period of time. We're going to have three main activities in the cash flow. We're going to have for operating activities, three sections of the cash flow statement. Cash flow from operating activity, cash flow from investing activity, cash flow for financing activity. Or in other words, how much cash we get and paid for the operating activities, how much cash we get and paid for the investing, and how much cash we get and paid for the financing activities. The last element of the financial statements was the note to financial statements, which including anything which is not included on those statements or additional explanation about the assets, liabilities, equity. Also, it's going to include summary of the accounting policy, how we apply the accounting policy, how we doing the accounting estimates in the company, and we may have here the segment reporting or some of the general reports for the assets, some extraction of the assets, and say, okay, for the accounts receivables, those accounts receivables coming from this and this and this and this client. Accounts payable are for this and this and this and this client. What else? Let's say deferred revenue, something that you delay, you're not recognizing it, right? You delay it. From where that comes from. If you have a prepaid expenses, what kind of prepaid expenses the company has. So that will be more detailed segment information about something which is sitting on the financial statements. And that's basically the overview of the financial statements and what the financial accounting in general is about.